As severe international conflicts escalate dramatically across the Middle Eastern region, the global gold market faces pressure. Intense downward momentum from a rapidly strengthening United States dollar continues dominating commodity exchanges across the globe. Traders watch nervously as physical bullion prices plummet, while fresh fears of unchecked consumer price inflation sweep everywhere. The robust United States currency acts as a tremendous headwind for valuable commodities priced in that denomination. When the dollar index gains substantial momentum, international buyers face much higher exchange costs for acquiring assets. This currency dynamic directly suppresses global demand for the traditional safe haven investment vehicle globally across all markets. The primary driver behind this sudden currency strength involves shifting expectations regarding the United States Federal Reserve. Market traders initially anticipated multiple interest rate reductions this year to support broader economic growth initiatives today. However, surging energy costs have completely altered that narrative by reviving serious concerns about persistent consumer price inflation. Global crude oil prices have nearly doubled since the beginning of the year due to regional conflicts. Brent crude oil hovered above $113 per barrel as regional tensions severely threatened supply. This massive surge in energy costs fundamentally alters the global inflation trajectory immediately for everyone involved right now. When daily fuel expenses rise, manufacturers are forced to pass those additional costs directly onto everyday consumers. This cost-push inflation scenario compels central banks to maintain elevated interest rates for extended periods globally. Higher borrowing costs ultimately reduce the overall attractiveness of non-yielding assets, like physical gold bullion, almost always. The vital Strait of Hormuz remains a critical chokepoint for approximately 20% of global oil consumption. Recent military engagements involving the United States Navy and Iranian forces have severely restricted commercial shipping traffic. These immense logistical disruptions create what financial analysts describe as a stagflationary supply shock environment globally right now. Project Freedom represents the United States military initiative designed to escort trapped commercial vessels through the strait. Despite these protective measures, major shipping companies remain extremely cautious about navigating these dangerous regional waters today. The ongoing physical impairment of energy transport routes guarantees that fuel prices will remain highly elevated locally right now. The International Monetary Fund recently issued severe warnings regarding the potential economic fallout from this prolonged conflict. Their expert economists indicated that global inflation could face serious setbacks if oil prices reach unprecedented heights. Such a devastating scenario would force international leaders to drastically reconsider standard economic growth strategies completely immediately today. Domestic gold markets across various Asian nations have reflected this massive international price correction quite clearly lately. In Vietnam, the price of plain gold rings experienced a substantial free fall during the morning sessions. Local buyers watched as domestic valuations quickly followed the downward trajectory from international benchmark prices locally right now. Similarly, Indian bullion markets witnessed sharp drops in overall valuation, offering some minor relief to common buyers. The spot price for 24-karat gold in Delhi fell by thousands of rupees over days. However, the weakened Indian rupee continues keeping domestic physical gold prices structurally high practically everywhere globally right now. This domestic currency depreciation in India acts as a major deterrent to mass jewelry consumption nationwide today. When local exchange rates plummet against the United States dollar, imported commodities become significantly more expensive locally. This specific price elasticity headwind crushes regional consumer demand, which traditionally supports the global gold market price floor. Silver prices also suffered heavy financial losses alongside gold during this chaotic period of intense market liquidation. Spot silver fell by over 3% as industrial demand concerns merged with broader global macroeconomic fears. Platinum and palladium markets experienced similar downward price trajectories, reflecting universal investor retreats from major global precious metals. Institutional investors and large money managers have aggressively decreased their bullish bets on gold futures contracts recently. Recent financial data indicates that net long positions have fallen to their absolute lowest levels in years. Meanwhile, short market positions have steadily risen, demonstrating growing professional consensus that precious metals face even further declines. Global gold exchange traded funds have also reflected this steady exodus of institutional and retail investment capital. Total physical holdings have declined by millions of ounces since the conflict initially broke out last February. Nervous investors appear to favor total market liquidity over the traditional perceived safety of tangible physical precious metals. Despite these massive institutional capital outflows, certain structural support mechanisms continue to prevent a total market collapse. Central banks around the entire world are still projected to acquire hundreds of tons of physical gold. This ongoing sovereign wealth accumulation provides a highly reliable long-term demand floor for battered global precious metals. Technical market analysts note that gold has broken through several critical support levels during this recent sell-off. The total failure to reclaim the $4,600 pivot point has shifted technical bias. Market momentum indicators highlight extreme price weakness, suggesting that further significant commodity price corrections remain very highly probable. The energy inflation paradox perfectly describes the current structural economic pressures weighing heavily on global bullion valuations. In standard geopolitical crises, gold usually rallies strongly based purely on widespread investor fear and systemic uncertainty. However, when military conflicts directly impair energy supplies, the resulting oil price surge creates massive, severely negative shocks. This specific type of supply shock lifts headline inflation, reinforcing expectations that central banks maintain restrictive policies. The European Central Bank recently revised its headline inflation expectations upward for the coming year quite significantly. The Reserve Bank of Australia also increased its baseline cash rate, essentially confirming these broader global economic fears. The upcoming transition in leadership at the United States Federal Reserve adds another layer of profound uncertainty. The newly nominated chairman holds a strong reputation for favoring hard money policies and strict institutional credibility. Market participants deeply anticipate a highly hawkish monetary approach, which has heavily contributed to the global dollar squeeze. This leadership transition occurs precisely when the global economy grapples with historically high levels of political uncertainty. The dangerous combination of new monetary leadership and ongoing international conflicts creates a uniquely challenging investment environment. Consequently, international capital flows heavily toward the highest yielding and safest government debt instruments currently available globally today. Commercial shipping redirection away from the Middle East has profoundly impacted international logistics and raw material supply. Dozens of massive cargo vessels have navigated much longer alternative routes to avoid the dangerous conflict zones. These extensive maritime detours require significantly more fuel and time, causing freight insurance premiums to continually multiply rapidly. The physical impairment of critical energy infrastructure extends far beyond simple crude oil extraction and daily refinement. Natural gas prices have also surged, creating cascading negative effects on the production of agricultural synthetic fertilizers. These interconnected industrial networks perfectly demonstrate how localized military conflicts generate massive economic shockwaves globally almost every day. United States macroeconomic data releases continue to play a crucial role in determining the short-term trajectory. The global market eagerly awaits the latest Services Purchasing Managers Index to gauge the overall economic health. Strong domestic economic indicators would further justify elevated interest rates, thereby pressuring gold valuations significantly downward even further. Conversely, any unexpected weakness in the domestic labor market could potentially revive dormant speculations regarding rate cuts. If national unemployment figures rise significantly, monetary policymakers might be forced to prioritize economic stimulation over inflation. Such a dovish policy pivot would immediately reduce the holding opportunity costs for precious metals across global markets. The current geopolitical landscape represents a dramatic deviation from historical market norms, where safe haven assets appreciated. The traditional valuation models used for pricing gold have temporarily failed under the immense weight of inflation. Modern investors must now carefully balance the psychological desire for security against actual market interest yields every day. Regional market variations further complicate the broader global narrative surrounding the ultimate future of precious metal investments. While international spot prices dictate the general trend, local currency fluctuations can either amplify or mitigate movements. Domestic buyers must constantly monitor both global commodity exchanges and national foreign exchange markets to find real value. In the United Arab Emirates, recent attacks on oil facilities have fundamentally altered the regional risk assessment. These unprecedented missile strikes demonstrate that no nation remains completely insulated from the expanding theater of operations. The resulting severe damage to critical infrastructure guarantees that regional energy markets will remain very exceptionally tight indefinitely. The global helium supply has also experienced severe logistical disruptions due to the ongoing hostilities near producers. This relatively obscure commodity plays a vital role in medical imaging technology and advanced semiconductor manufacturing processes. Sudden shortages in such critical specialized materials highlight the immense hidden economic costs of prolonged regional warfare today. As the conflict drags on, diplomatic efforts to establish a lasting ceasefire have repeatedly failed to produce. The United States and Iranian representatives remain entirely deadlocked over fundamental issues regarding regional security and access. This persistent diplomatic stalemate essentially ensures that massive market volatility will remain a constant factor almost every day. Market analysts warn that if crude oil prices spike toward $150, severe recession follows. The dangerous combination of massive public debt, sticky consumer inflation, and rapidly slowing economic growth appears toxic. Such a devastating macroeconomic scenario would destroy vast amounts of global wealth across all major financial sectors today. For professional wealth investors, the primary lesson of the current market cycle is abundantly clear and undeniable. When real treasury yields strong dollar valuations and severe energy supply shocks align perfectly, safe havens fall. The inescapable macroeconomic gravity of the global interest rate cycle completely dominates modern commodity prices locally right now. The United States military deployment to secure the commercial waterways requires an astonishing commitment of financial resources. Thousands of service members, alongside guided missile destroyers and advanced surveillance aircraft, are actively patrolling the region. This massive international show of force naturally raises the terrifying risk of direct armed confrontation almost every day. Agricultural commodity markets are beginning to feel the heavy burden of the Middle East conflict through expenses. Fertilizer manufacturing costs have skyrocketed following natural gas supply disruptions, directly threatening global food security and yields. International farmers worldwide face impossible choices between absorbing catastrophic financial losses or hiking everyday consumer food prices globally. The International Monetary Fund closely monitors the developing global situation, expressing deep concern over the cascading effects. Developing countries heavily dependent on imported energy and basic food face the very real prospect of crises. Emergency international liquidity support may become absolutely necessary for highly vulnerable emerging market economies in the near future. Technological advancements in artificial intelligence initially provided a massive boost to global equity markets earlier this year. However, the immense electrical energy requirements of these new technologies make them highly sensitive to pricing shocks. The ongoing regional war directly threatens to derail the much-anticipated economic productivity gains across the globe today. The highly interconnected nature of modern global commerce means that a disruption in one specific region radiates. The complete closure of vital shipping lanes forces cargo vessels to consume significantly more fuel during transit. This terrible logistical nightmare creates a vicious economic cycle of endlessly rising transportation costs for global consumers everywhere. Gold exchange-traded funds have seen massive portfolio liquidations as retail investors desperately seek to cover losses. The initial financial rush toward precious metals proved incredibly short-lived once the reality of rates settled. Aggressive profit-taking trading activities have heavily accelerated the downward price momentum very sharply across all exchanges globally. The United States dollar continues to flex its absolute financial dominance as the undisputed primary reserve currency. Despite growing international political conversations regarding potential currency alternatives, no other asset currently offers the same security. Scared investment capital instinctively flees toward the most heavily regulated and deeply liquid financial markets currently available today. The Federal Reserve currently finds itself trapped in an incredibly difficult position regarding its dual economic mandate. Raising baseline rates further to combat energy inflation risks triggering a severe domestic recession and corporate bankruptcies. Lowering policy rates prematurely could easily allow dangerous consumer price inflation to become permanently entrenched practically globally today. Industrial base metals like copper and aluminum initially diverged from precious metals due to severe mine closures. These base metals experienced intense physical supply squeezes that temporarily overshadowed the broader macroeconomic concerns pulling gold. Eventually, the rising fear of a synchronized global economic growth slowdown weighed heavily upon all commodity sectors everywhere. The Middle East conflict has also severely impacted the lucrative international luxury tourism industry across the region. Commercial airlines have canceled thousands of passenger flights, while luxury hotels report massive waves of booking cancellations. This sudden devastating loss of vital tourism revenue directly damages ambitious economic diversification plans for many nations globally. Remittance cash flows from migrant workers stationed in the Middle East are expected to drop precipitously soon. Millions of poor families in developing nations rely entirely on these regular financial transfers to purchase food. The sudden cessation of this critical international income profoundly threatens highly vulnerable households across the developing world today. The geopolitical risk premium previously attached to gold has essentially evaporated as the broader market rapidly adjusts. Institutional investors have coldly calculated that the physical destruction of energy infrastructure poses a far greater threat. This fundamental paradigm shift actively forces professional portfolio asset managers to completely rewrite their core trading strategies today. The Vietnamese domestic economy showed remarkable fundamental resilience despite the sudden collapse of local gold jewelry prices. International credit rating agencies recently upgraded the economic outlook for the rapidly growing Southeast Asian manufacturing powerhouse. Robust public government investment initiatives continue strongly supporting domestic economic growth despite the surrounding global market turmoil today. In stark contrast, local agricultural export markets for black pepper and coffee beans remained under severe pressure. The exceptionally strong United States dollar makes these vital export commodities much more expensive for international buyers. This difficult situation clearly highlights the highly complex economic interconnectedness of global currency fluctuations across developing nations today. The Japanese yen experienced extreme trading volatility, prompting aggressive interventions from the central bank to stabilize currency. These desperate national currency defense mechanisms add another layer of profound unpredictability to the chaotic foreign exchange. Professional currency traders must now carefully navigate active regional warfare and direct government financial market manipulation almost daily. The European Union faces immense economic challenges as it heavily relies on imported energy to power factories. The sudden massive spike in natural gas prices severely threatens the global competitiveness of European manufacturing facilities. Desperate regional policymakers scramble to immediately secure highly reliable alternative fuel energy supplies to prevent industrial collapse today. The United Kingdom national economy struggles to maintain positive growth momentum as the lingering energy shocks persist. The Bank of England remains highly hesitant to reduce borrowing costs, while domestic wage growth stays elevated. British citizens unfortunately face punishingly high household mortgage rates and continuously soaring monthly utility bills locally right now. The Chinese national economy actively attempts to leverage the current situation by expanding its geopolitical resource influence. As Western democratic nations impose strict trade sanctions, Beijing actively seeks to secure long-term energy contracts. This calculated geopolitical strategy carefully aims to permanently insulate the massive Chinese industrial manufacturing sector from shocks completely. The global transition toward renewable energy sources has gained absolute tremendous urgency in the wake of crises. Solar and wind power installations offer a desperately needed sustainable pathway toward true national energy supply independence. However, relying heavily on imported critical battery minerals presents new severe vulnerabilities for Western democratic nations globally today. Rare earth elements are absolutely essential for manufacturing high-capacity batteries and powerful electric motors required globally. The vast overwhelming majority of these critical natural resources are currently processed and controlled by rival nations. A sudden deliberate disruption in this supply chain would completely cripple the entire global green energy transition forever. The ongoing military conflict vividly illustrates the immense hidden fragility of the modern hyper-connected economic system. A single localized military engagement can instantly disrupt the complex flow of vital goods and investment capital. Nations around the globe are now aggressively prioritizing domestic supply chain resilience over pure economic cost efficiency always. The psychological toll of the prolonged regional conflict weighs incredibly heavily on consumer sentiment and business investment. When the economic future appears highly uncertain, multinational corporations inevitably delay expensive capital expansion projects across borders. This collective corporate retreat practically guarantees a highly significant economic growth slowdown across all major global markets today. The United States stock market has demonstrated a surprising degree of resilience despite the overwhelmingly negative news. Corporate earnings in certain key technology sectors continue to wildly exceed expectations, providing a strong market counterbalance. However, many prominent financial analysts warn that this intense equity market polarization remains highly unsustainable long-term everywhere. The complete utter failure of international diplomatic negotiations thus far suggests that a quick peaceful resolution fades. Both opposing sides appear totally entrenched in their respective political positions, unwilling to make the necessary concessions. This stubborn political intransigence ensures that the entire global economy remains a vulnerable hostage to regional violence daily. The profound, terrible human tragedy of the military conflict must never be forgotten amid the endless discussions. Beyond the wildly fluctuating commodity prices and complex inflation metrics lie completely destroyed communities and displaced families. The true devastating cost of modern warfare transcends any simple financial calculation or corporate quarterly profit report absolutely. As the whole world nervously watches the dangerous situation unfold, the absolute critical importance of robust cooperation. Multilateral global institutions must work tirelessly together to carefully manage the devastating economic fallout and prevent collapse. Only through highly coordinated global diplomatic action can we hope to successfully navigate this profound international crisis safely. The dramatic sudden fall in global gold prices serves as a stark warning about energy-driven inflation. When the basic fundamental cost of powering the global economy skyrockets, every single traditional investment paradigm shatters. Professional institutional investors must remain incredibly vigilant, constantly adapting their trading strategies to survive the market chaos completely. The coming turbulent months will undoubtedly test the absolute limits of global economic resilience and political wisdom. The ultimate final outcome remains entirely unknown, but the profound lessons learned will permanently reshape financial markets. We currently stand at a highly critical historical crossroads for the entire globalized international trading system altogether today. Market stability ultimately requires a fundamental restoration of secure commercial shipping lanes and reliable global energy supplies. Until these basic foundational economic conditions are met, extreme price volatility will dominate precious metals and equities. Global investors must heavily fortify their diverse financial portfolios against the continuing threat of prolonged geopolitical chaos daily.